Hey everyone, and welcome to this explainer. As a financial analyst, I'm going to be breaking down the macroeconomic realities of our current US debt, and more importantly, how you can actually shield your portfolio from the fallout. Look, if you've been watching the stock market swing wildly these past few months, or if you're just exhausted by the endless headlines about sweeping new tariffs and whispers of a looming market crash, you are probably wondering what in the world is actually going on behind the scenes. Well, the truth is, we're right in the middle of a massive structural economic shift. And honestly, almost no one seems to understand the real underlying cause of this impending disaster. So today, we aren't just going to stare at scary numbers. We're going to build a solid strategic defense plan for your long-term financial security. Let's get into it. So here's our roadmap for today. We're going to move from a macro diagnosis of the problem right down to micro, actionable steps. We'll start with the hidden $36 trillion threat, look at the echoes of the 2008 crash, and tackle de-dollarization. Then we pivot straight into defense mode, protecting your retirement assets, securing your household liquidity, and going over the exact warning signs you need to monitor.
All right, starting off with Section 1, the hidden $36 trillion threat, the math behind the macroeconomic iceberg.
$36 trillion. To put that into perspective, that is over $100,000 of debt for every single person currently living in the United States. It's a staggering figure. But the true danger isn't actually just that sticker price, it's the financing. The compounding interest payments dragging down the economy are the real anchor here. For years now, the U.S. has simply been spending far more than it earns. Sure, the government can theoretically just keep borrowing, but every single new loan raises that interest bill even higher. And with the Federal Reserve currently trying to navigate some really complex inflation challenges, any attempt to raise interest rates means the borrowing costs for the federal government absolutely surge. That long-term impact of high interest rates on the national economy, that's the true hidden weight that's pulling the whole system down.
Which brings us to a pretty crucial question. Are we just ignoring the warning signs again? I really want you to ask yourself if all the market chaos and the daily news headlines are actually distracting us from this massive structural threat underneath it all. I mean, we hear mostly about short-term stuff, right? A tariff here, an election cycle there, maybe a minor market correction. And sure, critics who dismiss these fears love to argue that the U.S. has faced deficits before and always recovered. But here is exactly why this historical deficit cycle is completely different from our current situation. Never before has the debt been on this massive of a scale, and never has it been coupled with such intense global tensions. It's just so easy for the average citizen to get caught up in short-term controversies and completely miss the slow-motion train wreck happening right in front of us.
Actually, let's think about it this way. Think of the domestic economy like a family living entirely on credit cards. If the credit card company keeps happily raising your limit, sure, you can carry on for a while. You feel fine. But eventually, a single missed paycheck or an unexpected recession will trigger a total collapse because the interest just entirely consumes you. The hope is always, well, we'll earn more in the future to pay off those loans, but that future date just keeps getting pushed further and further back. Now multiply that household scenario by trillions of dollars, and you're looking at the exact precarious environment the U.S. government is facing right now. Just look at this breakdown. Notice this 50-50 split. If this debt spiral doesn't slow down, we could realistically see half, or even more, of all tax revenue eaten up solely by interest payments. That means starving critical public programs like Medicare and Social Security. It is a frankly terrifying prospect for everyday citizens who are just trying to plan their long-term financial security. Politicians are going to be forced into some impossible, messy choices. They either slash government spending drastically, which means cutting the very entitlements that older citizens rely on, or they hike taxes aggressively, which instantly stifles business growth. Either way, the average taxpayer is the one left bearing this immense burden of just servicing the interest on past borrowing. Okay, Section 2, Echoes of the 2008 Crash. High-risk instruments hidden in plain sight. We all remember 2008, right? Back then, almost everyone saw the obvious signs of a housing bubble, and yet they largely ignored them. High-risk instruments triggered this massive chain reaction the second panic set in. Well, today, the crisis is once again hidden in plain sight, with the entire financial system propped up by a totally unsustainable foundation. The chilling reality here is that the new high-risk instrument isn't a subprime mortgage, it's U.S. national debt itself. Imagine if a major credit agency like Moody's or S&P decides to suddenly downgrade U.S. credit. The cost of refinancing would just skyrocket overnight. Panic would hit the bond market, the stock market would follow as corporate lending costs jump, and the global ripple effect would be absolutely catastrophic. The echoes of 2008 are deafening if you're actually willing to listen.
Let's move to Section 3, de-dollarization, shifting global alliances and trade levers. Now, completely setting politics aside for a second, whether you view the current administration's tariffs favorably or not, as financial analysts, we have to recognize what they are. They're a high-stakes gamble. The goal is to force a global rebalancing, but they carry severe risks of stagflation. These aggressive tariffs are essentially an attempt to claw back some economic control, forcing the world to buy more American products to reduce the trade deficit and lessen our dependence on foreign debt. But here's the catch. If foreign nations refuse to play along and start slapping us with retaliatory tariffs, we could easily end up damaging our own economy. We're talking about raising consumer prices right here at home and potentially facing brutal layoffs in key sectors.
And this ties directly into a fatal flaw in our current thinking: the assumption that the global appetite for U.S. debt is just limitless. It's not. If foreign powers decide to stop buying our debt, borrowing costs will surge, plunging the government even deeper into crisis. We are already seeing emerging powers, like the BRICS nations, actively forging non-dollar currency pacts to settle their trades. Even our historic allies are quietly hedging their financial bets. As foreign investors lose their appetite for U.S. bonds, the Treasury has no choice but to offer higher and higher interest rates just to attract them. Make no mistake, these shifting global alliances deeply threaten long-term American fiscal stability.
All right, let's pivot to solutions. Section 4, defending retirement assets, reallocating your portfolio against devaluation. For retail investors, this is absolutely crucial. As you map out your strategy to protect your retirement accounts from inflation, take a really close look at the risk profiles of these assets. Diversifying into tangible assets is essential, so you aren't trapped in dollar-denominated paper. Look at physical gold. It functions beautifully as a tangible safe haven and a hedge against inflation because its value isn't dictated by the federal printing press. Then you have foreign multinational stocks, which can completely mitigate your reliance on the US dollar. For those of you with a higher risk tolerance, crypto offers an alternative, decentralized asset, though you definitely have to stomach the high volatility there. But if you stay safely tucked solely in US bonds or rely entirely on a single US employer, you are leaving your savings incredibly vulnerable to sudden currency devaluation. Balancing your portfolio with these non-dollar assets is your best defense. Next up, Section 5, protecting household liquidity, surviving a sudden market freeze. Portfolio allocation is great, but we also need a survival plan for everyday cash flow. Think back to that 2008 credit freeze. If a meltdown strikes today, banks will absolutely tighten lending again. So here is your checklist. Step 1, build access to cash equivalents. You need a robust emergency fund with physical cash or highly liquid cash equivalents. Step 2, avoid fire sale liquidations of your core assets. Having that liquidity from Step 1 ensures you aren't forced to panic sell your retirement investments at the worst possible moment just to keep the lights on. And Step 3, beware of real estate vulnerability. A lot of people think property is the ultimate bulletproof safe haven. But if the broader economy collapses and mortgage rates surge even further, property values can stagnate or completely plummet, leaving your equity trapped. Finally, Section 6, warning signs to monitor, creating your macroeconomic dashboard. Listen, you don't have to be a Wall Street insider to see this coming. You just need to monitor this retail investor dashboard. Watch bond yields closely. If they start surging rapidly, it means investors are demanding higher payouts for the risk of holding U.S. debt. Pay strict attention to Federal Reserve interest rate announcements and any sudden policy shifts. Track spikes in federal deficit spending. Keep your eyes on global news from major players like China and Russia, shifting trade settlements away from the dollar. And of course, watch out for unexpected credit agency downgrades to the U.S. sovereign rating. A sudden shift triggered by any of these metrics could happen literally overnight. But by actively monitoring these specific early indicators, you can adapt your strategy proactively, way before the masses do. I want to leave you with this really provocative thought from our sources. Once the curtain falls on this $36 trillion drama, those who prepared might come out stronger, while everyone else will be left wondering how they missed the signs. Look, the national debt isn't just some boring talking point for election cycles. It's a mathematical reality. No one can promise a perfect outcome here, because the system is just so massive, with countless variables. But facing the truth, adapting your strategy, and staying vigilant, that might just be the difference between seizing an opportunity and losing everything when the house of cards eventually collapses. So take a hard look at your portfolio today and ask yourself, are you truly prepared for what comes next?